Very good morning to all. I hope that you all have a restful and great weekend. Welcome back to today's daily dose of market insights. Excuse me, I'm Kelvin here. So, what a dramatic weekend that we have. Number one is centered on rising geopolitical risk premium coming out from Middle East, where we start to see the key two stakeholders, US and Iran, entering into another game of poker, where both sides has now traded tit for tat retaliatory attacks towards one another, with Iran declaring the closure of Strait of Hormuz, and that created a stagflation fear risk back into the global markets again, where we start to see oil prices jumping up furiously at the start of today's Asia session, coupled with a mini risk-off episode seen on the S&P 500 E-mini futures as well as the Nasdaq 100 E-mini futures, dragging down the performance of the Asia Pacific stock market in line with a firmer dollar and a weaker gold price as we are speaking right now, 11:01 a.m. Singapore time. Good morning to all. Today, Monday. Today will be Monday, the 13th of July, 2026. So before we jump straight into the gist of today's daily dose, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. So very quickly, let's have a quick look of the key highlights that has taken shape in the last 48 hours or so, as well as in today will be the start of a brand new trading week. Hence, I will cover a full suite of all the intraday technical outlook that we usually do at the start of Monday for all those broad-based key cross asset classes. So let me share my screen. All right. So the key 48 hours news flow is pertaining to the rising geopolitical risk premium that is now taking shape in Middle East, where both of the key players or key stakeholders, US and Iran, engaging these tick for tat targeted attacks on one another. And in line over the weekend, where we have, I believe that it's about late Saturday or early Sunday Singapore time, where Tehran, which is Iran, has declared the Strait of Hormuz closed. So this Strait of Hormuz is very important. Why? Because it's where close to 70% of global oil and energy supply that's being flowing through to and fro in this Strait of Hormuz. So with the reclosure of the Strait of Hormuz, we may now start to see higher oil prices, which I have a kind of forewarned last week due to a interesting positive bullish reversal technical configuration on the West Texas oil that we cover on a frequent basis. And due to this reinforcing news flow, it indeed increases the risk of a multi-week bullish reversal on WTI or West Texas oil CFD. So later I'll touch that more in greater detail when I do the intraday technical outlook. So with this so-called fresh round of strikes that's being engaged on both sides, and we're still with the Iran declaring the closure of the Strait of Hormuz until further notice, that actually increased the risk of a breakdown of that interim peace deal between US and Iran that was signed around 3 weeks ago, and that could also potentially put on hold on this ongoing round of what I call it technical talks, where they have at least 60 days to negotiate a finalized permanent peace deal. So all these are now getting very, very fragile, and the global markets has really responded to that by pushing up oil prices. And what's interesting, that also causes the US dollar to strengthen as well as we're speaking right now, 11:04 a.m. Singapore time. So if you look at the yeah, 1 day rolling performance of the US dollar, let me highlight again, against other major currency, where the dollar is now performing the strongest against the risk sensitive Aussie dollar, up by 0.33% as we're speaking right now. And also the dollar yen is trading back up above 161.95 key hurdle level that is managed to surpass in today's early Asia session. So if you look at the 5-day rolling performance trend, it also seems to have starts to bottom up uh, during the last Friday US session second half, all right, where he hit an interim low and now is trying to do some kind of mini bullish reversal for the US dollar against the other major currency. And very interestingly, from a technical perspective, if we were to look at the strength of the dollar index, so the US dollar index, since the bullish breakout exposed FOMC on 18th of June, it continues to trade above this former key hurdle level, which is the former major complex sideways range resistance or range top that was previously in place since 29th of May 2025, broken up above it. Then thereafter, we see a series of 1 week plus of consolidation, holding above 100 and 100.54, 100.10. And what we could see is we see a series of bullish reversal candlestick where we have a bullish reversal daily hammer by the close of last Friday US session, right exactly at the retest of the rising 20-day moving average. And with today's Asia session, as we're speaking right now, 11:06 a.m. Singapore time, we have a positive follow through, indicating that the multi-week uptrend phase of the US dollar index remains intact potentially. All right. So with the strength of the dollar gaining firm, that also created a negative feedback loop on the futures, US futures, stock futures market, where we have the E-mini futures trading down by negative 0.43%, and the higher beta was hit growth-centric AI infrastructure, big tech team play Nasdaq 100 down by almost 1% and trading near the session low. So like I mentioned earlier in my previous two of daily dose, I have no conviction that the Nasdaq 100 is at the start of a fresh multi-week bullish impulsive up move, but rather is on a brink of breaking down a multi-week, a kind of a medium-term topish configuration after certain range support level that has taken down, that could potentially trigger a multi-week corrective move instead. So right now, this is a growing probability of what we are seeing right now on the global market space, taking into account of the slew of inter-market correlation. All right. So, and also what's interesting over here is that we know that Nasdaq 100 now is not the leading so-called barometer for a risk-on, risk-off global appetite. Everything is being centered on the rather highly volatile, top performing South Korea stock market, pardon me, due to their rising red hot performance of AI infrastructure slash high bandwidth chip stocks like SK Hynix. So SK Hynix was a very much hype up 2.65 billion secondary listing or ADR listing in the US on last Friday. But what's interesting, they faces this very typical exit liquidity by earlier insiders, where we start to see by this what it calls but sell the news, buy the rumor kind of effect. So SK Hynix slump. So as you are speaking right now, they are actually falling as much as a double-digit gain or double-digit losses of negative 11%. So with that, that actually also dragged down the Asia Pacific benchmark stock indices as well. So if you look at the South Korea KOSPI benchmark indices, the narrow one, which is KOSPI 200, down by negative 7.45%, trading at the session low. The wider KOSPI index is trading at negative 6.76%. And that created also a negative feedback loop into the Nikkei 225, which is also pretty much being led by AI related infrastructure, or not say infrastructure, AI related supply chain stocks, and as well as one of the leading component stocks that is have heavily been giving capital to listed AI related stocks, as well as unlisted AI related stocks, which is SoftBank. So the Nikkei 225 is down by negative 1.12%. The one that is kind of a bit muted from this fall in this AI related sell off is Hansing, which is only down by negative 0.22% due to the last week positive news flow, where we start to see the China central government pulling in a significant amount of capital into the Hong Kong capital markets. All right, so that just explains why the Hansing is falling of a lesser magnitude right now, negative 0.18%. And as if we go down the line, we have a bit of mixed bag on the China A shares market, where the narrower China A50 index is up by 0.17% over here. But however, the broader CSI 300 that comprises both the big cap stocks of Shanghai Stock Exchange and Shenzhen Stock Exchange is down by negative 0.82%. And closer to our shore, we have the ASX 200 down slightly, negative 0.34%, and our defensive STI is down marginally, negative 0.14% over here. All right, so that pretty much sum up the first segment of the daily dose, where I highlighted the key news flow slash macro driver that is having a leading front seat in the global markets for today. All right, so now let us now touch on the second segment, which I will cover all the intraday technical outlook segment. But before we do that, let me expand my screen over here. Great. So let's start with the FX market, starting with the euro dollar. So the euro dollar managed to stage that bearish reversal right exactly at the rejection of the 20-day moving average. And right now, it has started to break down below this so-called, okay, let me change this. Okay, no, let me put it in pink. All right, so it managed to stage this bearish breakdown and a gap down in today's Asia's opening session of this lower boundary of this bearish flag configuration that previously was in place since 24th of June. So with this bearish breakdown of this bearish flag formation, I would now tighten the pivotal resistance from 114.60 to 114.28 for today, which is pretty much close to the pullback resistance of this former bearish flag minor support level, maintain a bearish bias view on the euro dollar for today. Breaking below 113.85 potentially will see a retest of this next minor support level, which was the minor swing low of 26th of June and 1st of July at around 113.60 level. Okay, let me put it in writing, 1.1360. Breaking below 1.1360 will expose the all important medium term swing low of 113.30, 113.20, which is the 30th of May 2025 low. Only a bullish break up above 114.28 will negate the bearish tone to see a squeeze up to retest the stubborn range, intermediate range resistance that has been in place since 2nd of July at 114.60. Only breaking above 114.60 will see the extension of this minor mean reversion corrective rebound extending further towards the upside to expose the next intermediate resistance zone of 114.80, 114.94 next, right? So that's for the euro dollar, maintaining our bearish outlook on the intraday basis using a tighten slash adjusted pivotal resistance for today at 114.28. Next will be the sterling pound, the sterling dollar. So the sterling dollar also get rejected after playing around at the bunch of the key moving averages of the 50 and the 200-day moving average, where it reintegrate back below it in today's Asia session. So using last Friday US session high at 134.20, maintain a bearish bias outlook on the intraday basis for today for the sterling dollar. So right now it's actually testing a minor ascending trend line, which also could be also, if you put it, it will be like a bearish flag as well. So this bearish flag ascending trend line support level is about 133.70. So breaking below 133.70 will increase the odds of our intraday bearish outlook for it to revisit the next intermediate support zone at 133.25, 133.05 in the first step, which is the 20-day moving average as well. Below 133.05 may see further weakness towards the congestion area of 22nd of June and 1st of July, coming in as a next intermediate support zone at 132.62, 132.80. Only a bullish break up above 134.20 will negate today's bearish bias view to see the continuation of this minor mean reversion corrective rebound to expose the next resistance zone at 134.80, 134.94, which is also the medium-term descending trend line that has been in play since 28th of January 2026 high, and that's also from the current year-to-date high for the sterling pound as well that was being met at 28th of January 2026 this year. Okay, next up will be the dollar yen. So the dollar yen managed to reintegrate back above 161.95, which is a very important psychological level in terms of the prior 3rd/10 July major 2024 highs that was taken out previously on 1st of July, and where there was this Reuters report stating that next time the Bank of Japan/Japanese Finance Authority will rather do a sneak intervention movement in the FX market rather than give some kind of pre-warned verbal warning that causes the dollar yen to actually plummet on 2nd of July. Then thereafter, we see it whipsawing around 161.95, where we see an interim breakdown on last Friday Asia session. But however, in today's Asia session, it managed to recapture this 161.95 level. So hence, given that it's still playing this kind of whipsaw, but one thing positive for the boost in the dollar yen that is managed to go above 161.95, and also it managed to go above its 20-day moving average, where we see whipsaw price action previously on 10th of January as well, which was last Friday. So hence, having no change in terms of the view, still maintain a cautiously bullish outlook on the intraday basis for the dollar yen using the same pivotal support area, 161.45/28 will be last Friday US session low. So keeping a cautiously intraday bullish bias view for the dollar yen using 161.45/161.28 short-term pivotal support level. Next resistance zone to watch will be the retest of 9th of July at 162.73, 162.97. Only a bullish break up above 162.97 will potentially take us up higher towards 163.26. That is being defined by previously by the 18/22nd December 1986 minor congestion area. Breaking above 162.97, then I will be more confident to adjust the pivotal resist support level to 161.95. However, if price action don't move up as intended and starts to break down below 161.45/28, then potentially we may see another round of choppy downward drift towards the all-important support level, where the previous news flow slash related intervention fear managed to survive previously on 2nd of July. That will be at 16.90. Only breaking below 160.90 may unleash a deeper minor corrective decline sequence towards 16.30, maximum 159.75, 159.45, which also confluence with the 50-day moving average closely. Lastly, for the FX market update will be the risk sensitive Aussie dollar. So the Aussie dollar managed to get rejected right exactly at our pivotal resistance zone, 169.60, pardon me, 169.85 over here. So let me adjust it to 169.60. All right, given that it has broken below 160.30. Yeah. All right. So the other one will be 169.85. 0.69, pardon me, 6985. Okay, so right now it has already broken below this 60.30. Okay, using 169.60 as my short-term pivotal resistance level, which is very close to the 20-day moving average that got rejected on last Friday. Maintain that bearish outlook bias on the intraday basis for today on the Aussie dollar. Next two intermediate support level to watch, 69.10, 68.85, which is confluencing with the 200-day moving average. Breaking below it may expose further weakness on the intraday basis towards 68.63, 68.43. Only a bullish break up above 69.60 will negate the bearish tone to see a retest at 69.85. Going above 69.85 will see the extension of this minor corrective rebound sequence extending further towards 70.20. That also confluence with the medium-term descending trend line that has been in place since the high of 13th of May 2026. All right, so that's for the Aussie dollar. Next up, let's have an update on the global stock indices, starting with the Hong Kong 33 over here. So the Hong Kong 33 still facing a bit of headwinds, not headwinds, a bit of hesitance at our first resistance level that we highlighted on last Friday, where we have a bullish bias of it at 24,243, 24,393. So given that the weakness that is being seen on other global stock indices, I don't want to be so aggressive to maintain that bullish bias for today. So instead, I will have a neutrality stance. So neutral between 28 23,850, which was last Thursday bullish reversal low during the during the start of the London, I'll say, yeah, start of the London session. Right. So neutral between 23,850, upper limit 24,246, 24,393 for the Hong Kong 33. That's representing the Hang Seng Index. Next up will be the Japan 225. So the Japan 225 got rejected exactly at the retest of this descending trendline resistance that has been in play that prevents a further boost from taking further upside since the current all-time high area of 22nd of June 2026. So hence I will be having a tighten short-term pivotal resistance for today. Okay, at 68,360. 68,360. So the next one here will be the next previous resistance, next prior resistance. All right, let me tidy it up. Okay, good. So tighten the pivotal resistance to 68,360 over here. So with the next support level that is now testing coming in at 67,334, 67 figure level, breaking below it will expose further weakness towards 65,880, 65,084, which is this congestion area previously of 9th of June, 12th of June, managed to survive on the 8th of July during the first news break stating that the US Iran has started to engage in a kind of a mini tick for tat attacks on one another assets. However, if we start to see a bullish reversal back above 68,360, that will negate today's intraday bearish tone slash bias to see a squeeze up to revisit 69,285. Only a bullish break up above 69,285 will potentially usher in a much more pronounced recovery scenario for the Japan 225 to seek out 70,410, 7,890 in the first step. All right, so that's for the Japan 225 having a bearish outlook view for today on the intraday basis using a tightened short-term pivotal resistance at 68,360. Next will be the Germany 30. So in our last update on Monday, we expect the Germany 30, which is representing the German DAX, float down as expected and tested the 20-day and the 50-day moving average again. And right now is actually hovering slightly above the 50-day moving average, and we also a slight breach below this last week low at 24,910. Hence, I'll be using last Friday rejection level at 25,188, a tightened pivotal resistance level to maintain today's intraday bearish view slash outlook on the Germany 30 for it to drift down lower potentially. So breaking below 24,910 will potentially now expose the next intermediate support level at 24,625, which is the minor swing low of 24th of June and 30th of June. Below it may see further drift down to retest the 200-day moving average that is confluencing at 24,330 graphically. However, a bullish reversal back above 25,188 that would invalidate today's bearish buyer's view to see a squeeze back up towards 25,505, 25,400, 25,410, 25,505. So that is the former all-time high area. Previously, that was seen on the 13th of June over here, 13th of January, pardon me, this year, and 26th of May. All right, so that's for the Germany 30. Next will be the update on the major US stock indices, starting with the US Wall Street 30, representing the Dow Jones Industrial Average. So the US Wall Street 30 did that rebound as expected and almost hit our resistance level at 52,824 on last Friday. So last Friday it printed 52,771. All right, so give or take 52,777. So give or take is already is almost have fulfilled its potential upside move on the intraday basis. So hence, given the weakness that's being seen in other global stock indices and with the rising US dollar and rising oil prices, indicating the stagflation risk fear coming back into the picture again. Hence, I will have lesser conviction to maintain a intraday bullish view on the US Wall Street 30 that's representing the Dow Jones Industrial Average. So for today, I will flip to a neutrality stance instead. So neutral between last Wednesday low, which was also last week low at 52,130. Upper limit will be at 52,824. Right, so that will be the US Wall Street 30. Next will be the SPX 500. So the SPX 500 rejected that pivotal resistance zone that we highlighted on last Friday. So still maintaining this as an outlook, given that it's now trying to do a kind of a topish configuration since the current all-time high that was printed on 2nd of June this year. So with that, using 75.63, 75.77 as my pivotal resistance zone, no change for since last Friday. Maintain a intraday bearish view for the SPX 500 for today. Two key intraday support level to watch will be 75.15, 74.90. Breaking below it may expose last week low at 74.40. All right. Only a bullish break up above 75.57 will see a negation of today's bearish tone to see a retest at the current all-time high area at 76 figure level, which is 7,600, 76.25. Lastly will be the Nasdaq 100. So the Nasdaq 100 also rejected exactly at our pivotal resistance zone that we have on last Friday, and also rejected right exactly at the 20-day moving average, and now it's trying to break below again the 50-day moving average, indicating technical weakness or the lack of upside momentum. So using 29,800, 29,900 as it's now trying to get itself evolving within this topish configuration that has been in play since the current all-time high of 3rd of June. So 29,800, 29,900 maintain our short-term pivotal resistance level as it's now trying to push down towards the lower limit of this medium-term topish configuration that is now playing out. So key support level that is now testing it on the intermediate term, near-term basis, pardon me, 29,500, which is right exactly at the 50-day moving average. Breaking below it will expose 29,227, and further down towards the last Wednesday swing low area or low area at 29,047, 28,900. Only a bullish reversal back above 29,900 will negate today's bearish tone to see a squeeze up towards 30,106. Above it may expose 30,460 next. All right, so that's for the Nasdaq 100. Nasdaq 100. So that also wrap up our intraday technical outlook on all these global benchmark stock indices, CFD index. So next up will be the commodities market. Let me touch on the gold XAU/USD. So gold also got rejected exactly at 41.35. That was our pivotal resistance that we have on last Friday, which is also the 20-day moving average. So given that it hasn't broken down below 40.33, I do not want to tighten the 41.35 short-term pivotal resistance to today's gap down at 40.92. Hence, maintaining 41.35 short-term, medium-term resistance for now. Only a breakdown below 40.33, I will adjust the pivotal resistance slightly downwards towards the gap down resistance for today at 40.92. Next resistance, next support level to watch on the intraday basis, 39.60 for sure, 39.34, which is the minor swing low of 25th of June and 30th of June. Breaking below it will seek out 38.86 next. However, a bullish break up above this 41.35 that would negate today's bearish pressure to see a squeeze back up towards 41.80, followed by the all important 42.20, 42.43 level. 42.43 level, which is also the medium-term descending trend line resistance that has been keeping the bulls in check since 2nd of March 2026 high. Next up will be the so-called the West Texas crude oil. So let me share with you the West Texas crude oil right now. So from a weekly perspective, so this is the West Texas oil CFD as being quoted in our platform. The previous 3 months plus of decline has really hit a key inflection level. Later I'll share with you on the hourly chart at 66.60, 66.10, which I highlighted previously. And what's interesting is on last Friday, it managed to form a weekly bullish inverted hammer. So indicating that that could be the potential end of this 3 months plus of decline. And now we are on the brink of a potential multi-week bullish reversal move with a positive follow through for today. So if we could have a weekly close above the high of the weekly inverted hammer for this week, which is at this what's this level? Yeah, 76.60, then potentially this will increase the odds of a potential multi-week bullish reversal move for the West Texas oil. So this is the higher time frame. So given that the higher time frame has now formed a positive technical element, that actually increases the odds of our bullish intraday outlook as well for now. So given that it hasn't cleared above 76.60, so I don't want to tighten the pivotal support level to be so tight to today's gap up, which also correspond to the 20-day moving average at 73.16. So I'll be using last Friday pivotal support zone 72.37, 71.80 as my short-term pivotal support area. Two intraday resistance level to watch will be 75.12, followed by the all important last week high at 76.60, which is also the high of that bullish weekly inverted hammer candlestick that I shared with you guys earlier, as now continue to form a bullish reversal after the retest of 67.40, 66.10, which was the former major descending resistance from the 28th of September 2023 high. Next resistance level to watch above 76.60 on the intraday basis will be at 79.23, 80.75. Only a bearish breakdown below 71.80 will negate this bullish tone to see a retest at 69.88. Only breaking below it will expose the medium-term pivotal support zone at 67.40, 66.10. All right, so that's for the West Texas oil, still maintaining our bullish buyers outlook for today. All right, so that's a wrap for the second half of the second segment of the daily dose. Now let me move on to the final segment where I will cover is there any interesting key events / economic data release that we need to take note of for today, which is on the 13th of July. So today, 13th of July, will be rather a quiet session. So we do have a slew of US Federal Reserve officials speaking. So at 5:25 p.m. Singapore time, we have Fed Bowman speaking. Then thereafter, it will be a rather quiet session in terms of earnings result, in terms of economic data release. Pardon me. And at 14th of July, right early at 12:30 a.m. Singapore time, we have Fed Weller speaking. I think it should be at some kind of conference. Then followed by 12:45 a.m., we have ECB official Snubble speaking. And at 2 a.m., we have Bank of England Peer speaking. So this slew of central banks official speeches from ECB, Eurozone, and as well as UK could potentially shape the major US stock indices for the FX market. And giving a heads up, this week will be kind of unofficially kicked off the Q2 US earnings season for tomorrow. Later I'll touch more about it. Will be the release of the major US bank with the likes of Goldman Sachs that could also potentially influence the Dow Jones Industrial Average movement, which is the US Wall Street 30, given that Goldman Sachs is the top 3 component stocks inside the DJIA, which is the Dow Jones. So we can talk more about that for tomorrow. So for now, we also need to take note of the macro headwinds or the macro risk factor that is coming in the marketplace, which is all pertaining to this rising geopolitical risk premium, leading to stagflation fear coming back into the picture again, given the risk of the fragility of the interim US peace deal being broken down. And with that, that could also lead to another round of closure on the Strait of Hormuz, threatening higher oil prices. So do practice prudent risk management at this juncture as well. So with that, let's sum up today's daily dose. Have a great day ahead, and we shall speak again tomorrow. Thank you.